Okay, so let's just give you a reminder of what an MVL is. A Members Voluntary Liquidation is a procedure for a UK solvent company at the end of its useful life. They're often used when a business has been sold or the director members are ready to retire. Usually, all of the creditors will have been paid off and the assets sold, leaving the company with a nice pot of cash to distribute to its members, also known as shareholders. For years now, MVLs have been a useful procedure for shareholders of solvent limited companies to extract their cash in a tax efficient way. This is because the cash distributed by the liquidators to the shareholders is treated as a capital gain rather than income. This means shareholders can find their tax reduced from 40% to 24%. In addition, eligible shareholders can claim business asset disposal relief, BADR, previously known as entrepreneurs relief, and the capital gain is then only taxed at 10%. However, this 10% is increasing from 6th of April 2025 to 14%, and then again to 18% from the 6th of April 2026. If you're therefore thinking about taking up an MVO in the near future, you're going to need to be quick about it because you need to take advice from the companies and your own accountants and leave sufficient time for the company to be liquidated and have the distributions paid before the 5th of April in order to avoid paying that increased tax when the new legislation comes into force. We can liquidate a company really quickly, subject to how proactive the directors are at providing us with the necessary information and the accounts required. And then we can aim to pay an initial distribution of 80 to 90% within 7 days. The balance is often able to be paid within about 6 to 8 weeks later. So within about 2 months, the shareholders can have the bulk of their money sail off into the sunset.